Welcome back to the Deep Dive.
Good to be here.
It is Thursday, February 26, 2026. And if you've been following along with us this week, you know we are right in the middle of a marathon.
A massive one.
Yeah, we are dissecting one of the most complex, just sprawling corporate structures in Southeast Asia.
Genting Group?
Exactly.
Yeah.
And just yesterday, we wrapped up a really long session on the subsidiary, Genting Malaysia, GENM.
Right, the one we called the comeback kid.
Yeah, because they actually seem to be getting their act together.
It was a fun deep dive to do, honestly. It's rare you see a company pivot that hard from crisis management to actual profit generation in just a single quarter.
Largely thanks to the Forex markets finally giving them a break on that U.S. dollar-denominated debt.
Yeah, exactly.
But today, we are going upstairs.
To the parent company.
Right, the holding company, the empire itself, Genting Berhad. And quick note for those of you listening who might be new to this specific stock, it is pronounced Genting with hard G.
Good clarification.
We are looking at their Q4 2025 report today. It dropped less than 24 hours ago.
Hot off the presses.
Hot off the presses. And look, the mood in the boardroom of the parent company must be completely different from the party happening at the subsidiary.
Oh, it is the classic tale of two balance sheets.
Yeah.
While the child, GENM, is popping champagne over Forex gains and a stabilized New York outlook, the parent just posted a quarter that, well, at first glance, it looks like a disaster.
It really does.
We're talking about a significant net loss, a massive legal battle in the Bahamas, a family feud that just hit the high court literally this morning.
Which is wild timing.
And a failed privatization attempt that has left them in a very, very expensive limbo.
It sounds like a corporate soap opera.
It does.
But here is the hook, and this is why I love doing these deep dives. In our Q2 2025 analysis back in August,
Right.
you were brutal on this stock.
I was.
You gave Genting Berhad a financial moat score of 3 out of 10. You basically called it uninvestable.
I called it a value trap.
The value trap? Yes. But today, looking at your notes, despite the red ink and the lawsuits and the family drama, you are upgrading them
I am.
to a 6 out of 10.
Yes, a 6 out of 10. And I know how contradictory that sounds.
How do you lose money and get an upgrade?
Right, but the devil is in the details here. When you strip away the noise, and there is a lot of noise in this Q4 report, the investment thesis has fundamentally shifted.
Okay.
The risk-reward profile today is just completely different than it was 6 months ago.
All right, let's unpack that because we have a lot of ground to cover.
We really do.
We need to explain why the parent sank while the child swam. We need to talk about that failed privatization attempt.
The vulture move.
The vulture move, exactly. That didn't quite work out. And we need to discuss this 1.6 billion ringgit inheritance battle.
3 different wills?
Yeah, 3 wills and a lot of bad blood. Plus, we need to figure out why they are still paying dividends when they are losing money.
It's a lot.
So let's start with the headline numbers. A tale of 2 balance sheets.
Let's do it. So looking at the raw data for Q4 2025, revenue came in at 6.94 billion ringgit.
Okay, which on the surface looks stable.
Right. It's effectively flat compared to Q4 2024, which was 6.88 billion. But flat is a really dangerous word in a high inflation environment.
Because if your revenue is flat, your real purchasing power is actually declining.
Exactly. You are going backward.
But a flat top line is one thing. The bottom line was the actual shock.
It was a nasty surprise for the street. Genting Berhad posted a net loss of 289.97 million ringgit for the quarter.
Wow.
Yeah. To give you some context, in Q4 of the previous year, they lost about 169 million, so the loss has widened by nearly 71%.
That's a huge jump.
And if we zoom out to the full financial year of 2025, the company posted a net loss of 11.56 million ringgit.
Which is a stark contrast to 2024.
Very stark.
Because in FY 2024, they made a profit of 882.9 million ringgit.
Right.
So we have seen nearly 1 billion ringgit swing in profitability in just 12 months.
1 billion ringgit wiped out.
Now, in the GENM deep dive yesterday, we talked a lot about Forex.
We did.
We said the strengthening ringgit was a savior for the subsidiary because it reduced the value of their U.S. dollar debt.
Exactly.
Genting Berhad also has U.S. dollar debt. So why didn't they get that same benefit?
Well, they did get the benefit on the debt side, but Genting Berhad is a different beast structurally.
How so?
It is a true conglomerate. It has massive revenue streams coming from outside Malaysia, specifically Singapore, through Genting Singapore, the UK, and the US.
Okay.
When you are a global exporter of services, A strong domestic currency is a double-edged sword.
Because when you bring that money home to Malaysia, it's worth less.
Precisely. We call this translation loss.
Translation loss.
Yeah, think about Genting Singapore. They make money in Singapore dollars. When the ringgit strengthens against the SGD, that revenue number physically shrinks when it is consolidated into Genting Berhad's books.
Right, the accounting makes it look smaller.
Exactly. So while the debt got cheaper, which is a non-cash gain, the revenue looked smaller, which is a translation loss. For the parent company, the revenue hit from that translation completely eclipsed the debt benefit.
So it's an optical illusion of accounting, basically.
Mostly, yes. But it drags the headline numbers down hard.
Okay, so part of this Q4 loss is just currency fluctuation.
A big part.
But you can't blame $290 million in losses entirely on Forex.
No, you can't.
There has to be something else eating the capital here.
There is. The silent killer of corporate earnings.
Impairment.
Impairments. In Q4 2025, Genting Berhad recognized impairment losses of 207.7 million ringgit.
Okay, I want to push back on this term impairment for a second.
Go for it.
Because CEOs love to throw this word around during bad quarters.
They do.
They use it because analysts often treat it as a one-off or a non-cash item. Management says, oh, it's just a paper loss, our cash is still safe.
Right.
But an impairment is basically an admission of failure, isn't it? It's management saying, we bought this thing, or we built this thing, and we were totally wrong about what it's actually worth.
That is a very, very fair critique.
Thank you.
An impairment occurs when the carrying amount of an asset on the balance sheet exceeds its recoverable amount.
Right.
In plain English, the future cash flows you expected from that asset aren't going to happen.
You overpaid.
You overpaid, or the market changed. Now, usually, companies do this massive kitchen sinking exercise in Q4.
Kitchen sinking.
Yeah, throwing everything out. They clean up the balance sheet before the end of the year. In this case, the rise from 26 million in impairments last year to 207 million this year suggests they are writing down older assets.
Or adjusting for a higher cost of capital.
Precisely. Because interest rates are higher, the future money is worth less today, so the asset itself is marked down.
So it's likely a mix of older casino assets or some legacy investments that just aren't performing.
Exactly. It doesn't mean cash walked out the door this quarter.
Right.
But it means the capital they spent in the past has essentially been vaporized in terms of value.
Okay, so we have Forex translation hurting the top line and impairments crushing the bottom line.
Right.
But let's talk about the operational side, because a conglomerate is the sum of its parts.
True.
And usually, if one division has a bad quarter, another division picks up the slack. That's the whole point of diversification.
That is the theory, yes.
But reading this report, it feels like everything went wrong at exactly the same time.
It was a perfect storm of mediocrity across the board.
Mediocrity.
Yeah, let's look at the cash cow, leisure and hospitality. Specifically, Resorts World Sentosa in Singapore, RWS.
This is usually the engine that powers the entire group.
It is, but revenue was down.
Is that because of the Thailand threat? We've heard rumblings about Thailand legalizing casinos. Is that already biting into their market share?
Not yet. The Thailand threat is very real, but it's a future problem. We can touch on that in the strategy section later. The problem in Singapore right now is self-inflicted, but it's necessary. It's RWS 2.0.
The renovations.
Right. They are in the middle of a massive construction project. The Hard Rock Hotel was closed entirely for renovation.
And you can't sell rooms if the hotel is closed.
Exactly. And it is not just the room revenue that you lose.
Right. It's the knock-on effect.
If you have 500 fewer guests staying on the property, that is 500 fewer people eating breakfast.
500 fewer people buying luxury goods.
And critically, 500 fewer people dropping chips on the baccarat tables. It disrupts the entire ecosystem of the resort.
Plus, you mentioned in your notes the high base effect.
Yes. We do have to be fair to management here. Q4 2024, the comparison period, was spectacular.
Because of the post-pandemic wave.
Exactly. It was the first full post-pandemic Chinese New Year period with visa-free travel between China and Singapore fully ramped up. The numbers were artificially high because of that revenge travel wave. Comparing Q4 2025 to that peak makes the current numbers look like a decline, even if they're really just normalizing back to reality.
Okay, that makes sense. So Singapore is a construction zone normalizing from a peak. What about the U.S. and Bahamas?
This is where the currency issue hits the hardest. In local currency, in U.S. dollars, revenue is actually up.
Oh, really?
Yeah. The U.S. economy has been surprisingly resilient. People are visiting Resorts World New York. People are going to Las Vegas.
Okay.
But again, when you translate those USD revenues into a stronger ringgit, it shows a decline in the Malaysian books.
That must be so frustrating for investors.
It is, because the business is healthy, but the report looks bad.
Now let's move to the sector that genuinely shocked me. Plantations.
Oh boy.
Genting Plantations is usually the boring, steady, reliable child of the group. Palm oil prices go up, they make money. Prices go down, they make slightly less money.
Right.
But they rarely implode. Yet Q4 profit for the plantation division crashed by over 87%.
Implode is the exact right word. This was a bloodbath. And it wasn't a market issue. Crude, palm oil prices, CPO, they were actually decent.
So what happened?
This was a regulatory sniper shot.
The report mentions a fine. 96.6 million ringgit.
Yeah.
That is nearly 22 million US dollars. That is not a simple speeding ticket.
No, that is a massive, massive penalty. The report just describes it as an administrative fine imposed on an Indonesian subsidiary.
They're pretty vague about it.
They are, which is typical in these initial quarterly releases. But we can read between the lines here.
What's the likely cause?
In Indonesia, a fine of that magnitude almost always relates to HGU land titles, Hakiguna Usaha, or environmental non-compliance.
Could this be related to that recent crackdown we've seen on palm oil companies operating outside their designated concession areas?
That is the most likely scenario by far. The Indonesian government has been auditing palm oil estates heavily.
Using satellite imagery, right?
Exactly. They use satellites to see if companies are planting in forest reserves or just outside their licensed boundary.
And if they are?
If Genting was caught on the wrong side of a boundary line, the fines are calculated based on years of illegal profits from that specific plot of land.
So this 96.6 million isn't just a fine for this quarter.
No.
It's likely a retroactive penalty for years of operations.
Exactly. It is a catch-up penalty. That is why they are treating it as a one-off. But look, it raises a massive governance question for investors.
Because if they messed up the land titles on one estate...
Are there others? Exactly. Investors absolutely hate regulatory risk because it is totally unpredictable. You wake up one morning and 87% of your profit is just gone because a bureaucrat in Jakarta signed a piece of paper.
Wow. Okay, so that explains the crash in plantations. What about the power division?
The Banten power plant in Indonesia. They had weaker generation this quarter. They had maintenance outages. And this is the downside of the independent power producer model, the IPP model.
If the turbine isn't spinning, you aren't billing.
Exactly. It's a high fixed cost business. You have to pay for the plant whether it's running or not. So when revenue dips due to an outage, your margins get crushed immediately.
It really feels like Murphy's Law just struck Genting Berhad in Q4.
Whatever could go wrong did go wrong.
Construction in Singapore closed the hotels. Regulators in Indonesia fined the plantations. Maintenance in Banten stopped the power.
Yeah.
Is there any division that actually did what it was supposed to do?
Ironically, yes. The oil and gas division.
Which is usually the most volatile one.
Right. But it was the bright spot this time, specifically the FLNG project, the floating liquefied natural gas facility.
This is the hidden gem you've talked about before.
It really is. The construction of this FLNG facility is now over 54% complete, and they are finalizing the project financing right now.
Why is this so crucial?
Because right now, this division is a cost center. They are spending millions to build this massive floating plant.
Right.
But once it goes online, which is likely in late 2026 or early 2027, it flips. It becomes a cash cow.
Because it locks in those long-term gas contracts.
Exactly. It's a major diversification play that finally seems to be maturing after years of investment.
Okay, so operationally, the quarter was a mess, but arguably a temporary one. Construction ends, fines are paid, turbines get fixed.
Exactly. The operations will recover.
But now I need to talk about the structural trauma, because this is where the Empire Strikes Back theme really comes into play.
Yes.
Let's talk about the failed privatization of Genting Malaysia.
This is one of the most interesting corporate finance case studies in Malaysia of the last decade.
Let's set the scene for the listeners. Late 2025. Genting Berhad, the parent company, decides it wants to own 100% of Genting Malaysia.
Right. They launch a takeover bid.
The offer was what, 2.35 ringgit per share?
It was 2.35, and we discussed this extensively back then. It was a low-ball offer.
Super low.
It valued the company well below its net asset value, and it completely ignored the potential of the New York casino license. It was purely opportunistic. They tried to buy the dip.
And the minority shareholders, the retail guys, and the institutional funds basically said, no way.
They revolted. The offer officially closed on December 1st, 2025.
Right.
Now, to force a compulsory acquisition, basically to kick everyone else out and take it private, they needed 90% acceptance.
Okay.
To even trigger a delisting discussion comfortably with the exchange, they needed 75%.
And what did they get?
They got 73.1%.
Man, so they missed it by less than 2%.
It is agonizingly close. It puts them right in what we call the zone of pain.
The zone of pain. Explain that.
Well, if you own 40% of a company, you are a controlling shareholder. You call the shots.
Right.
If you own 100%, you are the sole owner. You take all the cash. But owning 73% is just awkward.
Because you still have public shareholders to deal with.
Exactly. You have to consolidate the accounts, but you still have to deal with the Bursa Malaysia listing requirements. You still have to hold annual general meetings.
And face angry minority shareholders.
Right. Shareholders who know perfectly well you just tried to buy them out on the cheap.
But here is the real financial kicker to all of this. To fund this attempt, the parent company spent billions.
Yes.
And they didn't just use cash on hand, they borrowed it.
Correct. They issued 3.0 billion ringgit in medium-term notes, corporate bonds.
Right.
The idea was simple. Borrow at, say, 5% interest, buy the company, and use the company's own cash flow, which yields maybe 8% to pay off the debt.
It's a classic leveraged buyout move.
Textbook.
But because they didn't get 100%, they don't have full access to GENM's cash flow.
Exactly. They only get the dividends that GENM decides to pay out.
Oh, and that creates a problem.
A huge one. This is what we call negative carry.
Negative carry.
They are paying interest on 3 billion ringgit of debt, but they can't access the full operating cash flow of the subsidiary to service that debt. They have to wait for GENM to declare a dividend.
And GENM needs its cash right now for the New York expansion.
Exactly. So GENM's dividends might not even cover the interest payments on the parent company's debt.
That just sounds like a massive strategic blunder.
Yeah.
They loaded up the parent company with debt for a prize they didn't even win.
It creates a real liquidity strain. In fact, on December 30, 2025, so just about 2 months ago, they had to do a debt shuffle.
A debt shuffle.
A subsidiary called Genting Vista issued new bonds just to refinance the old ones. They're basically playing musical chairs with billions of ringgit just to keep the lights on.
Wow.
The finance costs for Genting Berhad are now nearly 500 million ringgit per quarter.
500 million in interest.
Yeah.
Every 3 months.
It's staggering.
It really is. And it completely explains why they are posting a net loss. The operating profit is just being eaten alive by these interest payments.
It is. And this brings us back to why I upgraded them.
I was going to say, how are you upgrading this?
Hear me out. The fact that they were willing to borrow 3 billion ringgit tells you something very important.
What's that?
It tells you that the insiders, the people who see the daily revenue reports, the people who know exactly what's going on in New York, believe the stock is worth way more than 2.35.
They put their money where their mouth is.
Exactly. They failed to execute the buyout, sure, but the signal to the market was wildly bullish. Insiders are buying.
Even if the insider is just the parent company.
Right.
Okay, I see that logic. I do. But before we get too optimistic about this stock, we have to talk about the courtroom.
The soap opera.
Segment 4, the soap opera. Because this is the stuff that makes institutional investors really nervous. It gets personal.
It gets very personal. The Lim Soo Kim estate battle.
This has been simmering for a while, right? Since 2022. But it just boiled over again.
It did. Let's give the listeners the family tree context first.
Good idea.
Lim Soo Kim was the youngest daughter of the founder, the legendary Tan Sri Lim Gotong.
Right.
She passed away in 2022, and she left behind a fortune estimated at 1.6 billion ringgit.
That is about 522 million US dollars. It's a massive, massive estate.
Massive.
Yeah.
And the fight is between her 3 daughters on one side and the executors of the estate, along with her son Marcus, on the other side.
And the accusation here is straight out of a movie.
It really is.
The daughters are claiming their mother signed 3 different wills in rapid succession while she had stage 4 cancer.
Right. They are alleging fraud and undue influence.
Basically saying, Mom wasn't in her right mind, and you forced her to sign us out of the money.
It's tragic, honestly, on a human level. But why does the market care? Why are we analyzing this in a financial deep dive?
Because family dynamics drive corporate dynamics.
Exactly. In a family-controlled conglomerate like Genting, the stability of the family is the stability of the company. If the siblings and cousins are suing each other for fraud, it creates cracks in the voting bloc.
It creates distraction at the board level.
Huge distraction.
And there was a major update just yesterday, February 26th, right? What happened in the High Court?
The administrators of the estate tried to block the son, Marcus, from submitting certain evidence. They raised what's called a preliminary objection.
Trying to win on a technicality.
Exactly, trying to shut down his arguments before trial. But the judge, Mazan Mataib, dismissed that objection yesterday morning.
Oh, wow.
She effectively said, no, we are going to hear everything. Proceed to full trial.
So this is not going away quietly in mediation. This is going to be a loud public trial.
Which means more headlines, more dirty laundry being aired, and more of a governance discount applied to the stock by institutional investors.
But frankly, that's just reputational risk.
True.
There's a financial risk hanging over them that is much more tangible, the lawsuit in the Bahamas.
Ah, yes. The RAV Bahamas case, this is the nuclear option.
We mentioned this briefly in the intro. Break this down for us.
RAV Bahamas is the minority partner in Resorts World Bimini.
Okay.
They have sued Genting Americas, which is a subsidiary of Genting Berhad. And the accusation is incredibly serious. They aren't just saying, hey, you did a bad job managing the resort.
What are they saying?
They are saying you committed fraud.
Specifically, they're accusing them of dumping costs. Can you explain what dumping costs means in this context?
It's a transfer pricing issue. Let's simplify it. Say Genting has a headquarters in Miami, and they have the resort in Bimini.
Right.
The accusation is that Genting Americas took expenses that rightfully belong to the Miami office or other profitable units and assigned those expenses to Bimini's books.
Why would they do that? Just to lure the profit of Bimini?
Exactly, because Genting owns 100% of Miami, but only a portion of Bimini.
Oh, I see.
By shifting costs to Bimini, they starve the minority partner RAV Bahamas of any profit payout while keeping the cash in the entity they fully own.
That is, well, if that's true, that's just theft.
That is exactly what RAV Bahamas is claiming in court, and they are seeking $600 million in damages.
$600 million.
Which is roughly 2.66 billion ringgit.
If they lose that lawsuit, that is years of profit just gone. Poof.
It is classified as a material litigation. Genting filed a motion to dismiss it, basically saying the case was totally baseless.
Did it work?
No. The U.S. court rejected the motion to dismiss, so this is going to trial, or more likely, it'll end up in some massive mediation settlement.
But until it is settled, there is a 2.6 billion ringgit sword of Damocles, just hanging right over the stock price.
Exactly. The uncertainty is brutal.
So let's summarize where we are. High debt, massive interest payments, family lawsuits over wills, commercial lawsuits over fraud in the Bahamas, and a net loss for the quarter.
Sounds terrible.
And yet,
Yeah.
Segment 5, the dividend.
They declared a dividend.
They declared a dividend, a final single-tier dividend of 5.0 Zen per share.
Which, to be fair, is a 50% cut from last year.
True, the total for FY 2025 is 5.0 Sen, down from 11.0 Sen in 2024. But the question you have to ask as an investor is, why pay anything at all?
Right.
If you are losing money and you're paying 500 million ringgit a quarter just in interest, why send cash out the door to shareholders? Why not hoard every single cent to pay down debt?
It's the logical question. And there are two theories here on why they maintain the dividend.
Let's hear them.
Theory one is the institutional floor theory. If you cut the dividend all the way to zero, many pension funds and income-focused mutual funds are legally required to sell your stock.
Because their mandate says they can only hold dividend-paying assets.
Exactly. They cannot hold non-dividend payers. If they all sell at once, the stock crashes to maybe 2 ringgit.
And Genting can't afford a stock crash.
No, because their shares are often pledged as collateral for other loans.
Ah, the collateral issue. If the share price drops too low, the banks make a margin call.
Precisely. So they pay a token 5.0 Sen dividend just to keep the institutions happy and the price relatively stable.
Makes sense. What's theory 2?
Theory 2 is the upstream theory.
Follow the money.
Always follow the money. Who is the biggest shareholder of Genting Berhad?
Quinwat Realty.
Right, the private holding company of the Lim family. Quinoa has its own massive debts. It has its own private expenses. It needs cash flow desperately. And the only way Quinoa gets cash is if Genting Berhad pays a dividend.
And the only way Genting Berhad gets cash is if Genting Malaysia and Genting Singapore pay dividends up to them. It's a cascade.
It's a waterfall. Even if the river is running dry, the person at the top of the pyramid needs their drink.
Wow.
This is why, historically, Genting rarely skips a dividend entirely, even in terrible years. The family structure simply demands liquidity.
It is so fascinating how the private family needs essentially dictate the public corporate strategy.
It's the reality of family conglomerates in Asia.
Okay, let's pivot and look forward. We've covered the mess, the Q4 numbers, the fines, the lawsuits. Now let's cover the strategy. Segment 6, strategic outlook.
The empire strikes back.
Exactly. You mentioned earlier that their ace in the hole is New York.
This is the binary event that defines the entire stock for the next 24 months, the New York downstate casino license.
We expect a decision on that in late 2026.
Yes, late 2026. And Genting has been positioning for this incredibly aggressively.
Aggressively is an understatement. In May 2025, Genting Malaysia acquired the remaining 51% of Empire Resorts. We talked about this in the GENM deep dive yesterday.
We did. They now own 100% of the Resorts World Catskills and the mobile sports betting arm in New York.
But why does the parent company care so much about that specific consolidation?
Because if Genting Malaysia wins that downstate license, Resorts World New York City and Queens transforms overnight.
Right now, it's just a casino, right? Mostly just slot machines.
Exactly. But with the full license, it becomes a full-blown Vegas-style casino. Live table games, poker rooms, high roller suites.
The revenue potential completely changes.
It doubles, maybe even triples. By consolidating Empire Resorts now, Genting has ensured that 100% of that potential upside stays in the house.
They didn't want to share the New York winnings with any minority partners.
Exactly. It is a double or nothing bet. If they win the license, the stock price of GENM and by direct extension, the parent Genting Berhad will absolutely skyrocket.
And if they lose?
If they lose, they are stuck with a mountain of debt and a rather mediocre asset up in the Catskills. That is the risk.
Right.
But the strategic clarity of the move is a big reason why I'm upgrading their Moat score. 6 months ago, the Empire Resort structure was super messy. Related party transactions, partial ownerships.
Now it's clean. They own it.
They own it. The path is clear.
What about the other catalyst we touched on earlier, Thailand?
Thailand is the wild card. The Thai government is moving really fast to legalize casinos to boost their tourism sector.
And Genting Singapore is watching this like a hawk, I assume.
Oh, absolutely. It's a huge threat. Because Bangkok is cheaper and arguably much more fun than Singapore for a lot of regional tourists.
Yeah, true.
But it's also an opportunity. Genting Singapore is sitting on a massive pile of cash. They could easily bid for a license in Thailand themselves.
Man, if Genting gets a foothold in Thailand, they effectively encircle the entire region. Malaysia, Singapore, and Thailand.
That is the dream scenario, the Pan-Asian gaming monopoly. It is speculative right now, but Genting is one of the very few operators with the balance sheet and the political know-how to actually pull that off.
And what about domestic catalysts? Visit Malaysia year 2026.
It's happening right now. The government is pumping millions into global advertising.
Which should naturally lift the visitor numbers at Resorts World, Genting up in the Highlands.
Exactly. It's a macro tailwind that doesn't require any extra investment from Genting. They literally just have to open the doors and let the tourists walk in.
Okay, we have arrived at the verdict, segment 7, the financial moat scorecard.
There we go.
In our Q2 2025 deep dive, you gave Genting Berhad a 3 out of 10. You cited the confusing corporate structure, the high debt, and the low return on invested capital.
All true at the time.
But today, despite a net loss, you are moving them to a 6 out of 10.
I am.
You really need to convince me here, because as I'm a listener, I'm hearing loss, lawsuit, debt, fine. That sounds like a 2 out of 10?
It does if you only look backward. But investing is entirely about looking forward.
Okay, lay out the case for a 6.
It is based on sum of the parts valuation, SOTP.
Break that down for the audience.
Genting Berhad is a holding company. Let's just add up what it physically owns.
Okay.
It owns 52% of Genting Singapore. That publicly traded stake alone is worth billions.
Right.
It owns 49% and effectively controls Genting Malaysia. It owns 54% of Genting Plantations. It fully owns the energy division, the oil and gas and power assets. It owns prime property in Miami and the Bahamas.
So you add all that up.
You take the market value of its stake in Singapore, plus Malaysia, plus the plantations. Then you subtract the parent company debt. The
Okay.
current stock price of Genting Berhad is trading at a massive, massive discount to that sum.
The classic conglomerate discount.
It's not just a discount anymore, it is a crater. The market is basically valuing the non-listed assets, the energy division, the U.S. real estate, the life sciences, bets at effectively zero, or even negative value.
So what you're saying is, if I buy Genting Berhad stock today, I'm buying the Singapore and Malaysia casinos at a steep discount, and I'm basically getting the oil and gas division and the New York potential for free.
That is exactly the value proposition. The downside is already priced
The
in.
market already knows about the lawsuit.
Yes, it knows about the debt, it knows about
Yeah.
the fines. That's exactly why the stock is down 22% over the last year.
But the upside isn't priced in.
Right, the FLNG facility coming online and generating cash. Not priced in. The potential New York license win, not priced in. A recovery in dividends, not priced in.
So the 3 out of 10 score was because the price was too high for the mess they were in.
Exactly.
And the 6 out of 10 is because the price is now so low, the mess is mathematically acceptable.
Spot on. It's a pure valuation call. Now, it's still risky. Let's be clear. This is not a stock for widows and orphans.
Definitely not.
But for an investor who is willing to wait 24 months for that New York decision and the FLNG launch, the risk-reward is wildly asymmetric in your favor right now.
That is a very compelling argument. It's almost like cigar butt investing.
Yeah.
It looks ugly, it's discarded, but there's a few really good puffs left in it.
Or perhaps it's a phoenix rising from the ashes. The empire has taken a serious beating, but it is still an empire.
So let's wrap this up with our outro. Genting Berhad is cleaning house. They are taking the pain right now, writing down bad assets, fighting the lawsuits, refinancing the debt.
Yeah, getting it out of the way.
The Q4 loss is ugly on paper, but the actual cash generation machine, the EBITDA, is still running at 1.75 billion ringgit a quarter.
The machine isn't broken, it's just heavily burdened.
Right. And my final provocative thought for the listener involves that failed privatization attempt.
Okay.
Genting Berhad owns 73% of GENM. They wanted 100%. The stock price of GENM is still languishing, and Genting Berhad is already paying massive interest on the money they borrowed to buy it.
They are paying for dinner they didn't even get to eat.
Exactly.
Oh,
So my
yeah.
question is, will we see privatization attempt 2.0 in 2026?
It's a great question.
Logic says yes. They desperately need that GENM cash flow to pay their own debt. But will they actually learn their lesson?
If they try again, they simply cannot offer 2.35. The minority shareholders have proven they have a spine. They will have to offer a fair premium, maybe 3 ringgit.
And that would be the real game changer. If you're holding GENM shares, you are just hoping for that new bid. But if you're holding Genting Berhad shares, you are praying the parent company doesn't overpay.
It's a high-stakes poker game between the parent and the child, and the rest of the market is just watching from the rail.
What a fascinating setup for 2026. Listeners, we want to hear from you. Did you hold on to your GENM shares and reject that buyout offer last year?
And do you think the parent company is a value trap or a genuine value play at these depressed levels?
Yeah, and specifically, do you think that Three Wills family lawsuit actually matters to the long-term stock price, or is it just tabloid noise? Let us know your thoughts in the comments.
We read all of them.
And as always, tell us what stock we should cover next. We love digging into these complex, messy corporate webs. Thank you so much for trusting us with your time today. Like, subscribe, and we will see you on the next deep dive.